Take a look at this chart. Is this chart bullish or bearish? You have 3 seconds to decide. If you struggle to answer, or if you said bearish, you are encountering the same obstacle that affects the majority of traders. Most traders get this wrong, or they get it right by accident. This leads us to the most common trap in price action trading. The problem is that you are focusing on the wrong information. There is a concept that explains this perfectly. Most traders are zoomed in so far, they are watching every single tick and fluctuation. It is like reading one single sentence from a book and trying to understand the entire plot. It is impossible. To understand the market, you must zoom out and read the whole chapter. This brings us to the core concept, the time frame disconnect. You have two different views of the market. First, you have the micro view. This is your lower time frame. It is filled with minor structure breaks and random noise. Second, you have the macro view. This is your higher time frame. This is where the real trend and the institutional flow are clearly visible. The conflict between these two views creates the pullback trap. Here is how it works. Imagine the macro chart is in a strong, clear uptrend, higher highs and higher lows. Eventually, the market begins a healthy, normal pullback. This is where the trap occurs. If you zoom into the micro chart during this pullback, the picture looks completely different. On the lower time frame, that healthy pullback looks like a reversal. You see lower lows and bearish momentum. Your technical analysis tells you the trend has shifted down, so you take a short position. But in reality, you are shorting a healthy pullback right before the macro trend resumes. You are betting against the dominant momentum. This leads us to the most important rule of this video. When the macro and the micro tell two different stories, the micro is usually wrong. You are not losing because your strategy is broken. You are losing because you are applying it in the wrong context. So, how do we fix this? The solution is a simple framework. Before you draw a single trend line or look for an entry pattern, you must zoom out. The higher time frames show you the footprints of the smart money. Here is the professional playbook in 4 steps. Step 1. Identify the macro trend. Is the market clearly moving up or down on the higher time frame? Step 2. Wait for the pullback. Do not chase the move. Wait for price to correct against the trend. Step 3. The micro confirmation. This is the only time you zoom in. You are not looking for a reversal of the big trend. You are looking for signs that the pullback is ending. Step 4. The entry. You enter in the direction of the macro trend, positioning yourself for the next impulsive leg. If you want to actually master price action from the ground up, my course walks you through the entire approach, step by step. The link is in the description and in the pinned comment below. This brings us to the final concept. Alignment. High probability trades only occur when the macro and micro are in agreement. Think of it this way. The macro time frame provides the strategy. It tells you the direction of the river. It tells you what to do. The micro time frame provides the timing. It tells you exactly when to launch your boat. One gives you the direction, the other gives you the signal. You only execute when both are pointing the same way. What happens if they are not aligned? If the macro is bullish, but the micro is bearish, that is not a trade signal. That is a signal to wait. It means the market is not ready. Understanding this distinction changes how you view price action. The structure on the lower time frames does not define the trend. It simply shows the noise within the trend. The higher time frame creates the structure that the rest of the market must follow. So the next time you feel confused by a chart that looks chaotic, remember that confusion is usually a signal that you are zoomed in too far. Zoom out, identify the real structure, and trade with the current, not against it. If you found this breakdown helpful, make sure to hit that like button. Drop a comment below and let me know if you want to see more deep dives like this. And finally, subscribe for more price action breakdowns. I'll see you in the next one.